Good morning. Welcome to Market Monday for January 27th, 2025. Well, so far so good, as it appears that U.S. stock market performance looks to be in line with historical non-recessionary cutting cycles. Yes, we are still in a cutting cycle. Here's that first cut, and then 6 months, a year, and 2 years out. Of course, here's the stock market when there is a recession. Hence, such a focus on the economy amidst a rate cutting cycle. The green is what's called normalization, meaning maybe rates got a little high, inflation seems to have cooled a bit, and the Fed is sort of course correcting. And that's where we are here in black. Still early days, but at least according to this, the Atlanta Fed's real-time nowcast of economic growth, or GDP, tracking at 3%. At least for now, we all have to keep waiting for the imminent recession we were all promised over the past 2 years. Something Matt was talking about last week continues to make its way into the headlines, which is the topic of valuations. Is the market expensive? Is the PE ratio, as Matt discussed, too high? Another way to think about this topic is to ask ourselves, why might PE ratios be tracking higher? Here we see, number one, earnings expectations are continuing to blast higher. Here's the bear market of 2022, where earnings actually declined, then ripping higher ever since. But not only that, profit margins are at their highest of this cycle, well above pre-pandemic levels. So not only do we have earnings blasting higher, but profit margins are expanding at the same time. When this happens, the PE ratio naturally expands. It's just what happens. So again, clearly not a cheap stock market, but in and of itself is not necessarily cause for concern. Something else we're likely to see is the so-called Buffett Indicator, of course named after value investor icon Warren Buffett, the Oracle of Omaha, as they call him. The Buffett Indicator looks at the comparison between corporate profits and GDP, or economic growth, as we just looked at a minute ago. So back in 1999, Buffett says, quote, "You have to be wildly optimistic to believe that corporate profits as a percent of GDP can, for any sustained period, hold much above 6%. Fair enough. Here we're looking at that ratio, corporate profits as a percent of GDP, since the 1950s. That enough data? And it's true. There seems to be this long-run gravity around that 6% figure. But starting in the early 2000s, likely driven by the tech and internet boom finding its footing, seems to have found a higher level, a higher gravity at 50% more, 100% more than Buffett's original hypothesis. If that wasn't enough, Buffett's longtime partner, Charlie Munger, may he rest in peace, said, quote, "Just because Warren thought of something 20 years ago doesn't make it a law of nature. There is no natural correlation between GDP and corporate profits." So while we have great admiration for Warren Buffett and what he has accomplished, we can't run our entire investment strategy based on these things, frankly, that are best reserved for headlines. And that said, it would be hard to argue that large US stocks are cheap. Those looking elsewhere for a better value may consider small companies. After all, we're approaching 800 days since the small cap Russell 2000 index has made a new all-time high. The only other times in history it's gone longer were after the dot-com crash and global financial crisis. Pair that with not so small expected earnings growth over the next year and a half, much stronger compared to the large cap US S&P 500 stock market, and that's a fairly compelling case for diversification within our equity portfolios. And today, we'll leave you with, there's still $7 trillion in money market funds. Have a great week.